Welcome to This Explainer. Look, if you're sitting in the C-suite, it's incredibly easy to just brush off daily market movements as mere noise, right? But what if I told you that hidden right there within the institutional buying data, the block deals, and those rapid sector rotations is a massive amount of strategic intelligence? Today, we're going to decode that intelligence and translate complex trading notes into a highly actionable playbook for corporate leaders.
Okay, let's jump right into the agenda. We'll be looking at market dynamics and sector rotation, institutional buying and volume signals, managing cap table transitions, and finally, navigating event risks.
So what does this all mean? How exactly do market signals drive your corporate strategy? Well, as an executive, you aren't just reacting to stock prices. You're actively trying to anticipate the macroeconomic weather. We are going to take raw institutional movement and turn it into the kind of strategic foresight that can totally guide your next quarterly earnings call, your capital allocation, or your operational focus.
Starting off with Section 1, Market Dynamics and Sector Rotation, let's look at the CEO's macro perspective.
Check this out. The data reveals a massive sector rotation happening right now. For 3 consecutive quarters, large-cap stocks have severely underperformed. In response, foreign institutional investors, or FIIs, aren't just sitting on their cash. No way. They're actively rotating their capital, completely abandoning those large caps to heavily accumulate shares in mid-cap IT. If you're a CEO in or even adjacent to these sectors, this is a glaring signal about where the market actually sees future growth.
Now, this institutional accumulation isn't just random dart throwing. It's driven by a very specific fundamental thesis. The smart money is flooding into mid-cap IT because of 2 major catalysts: really strong deal wins in the banking, financial services, and insurance sector, and a highly anticipated margin recovery. Basically, the market is pricing in operational efficiency. For a CEO, this means if your firm is fighting for capital, you've got to be aggressively highlighting your own deal pipelines and your roadmap to margin expansion, because that's exactly what institutional buyers are rewarding right now.
And we're seeing the exact same kind of momentum over in capital goods. Again, as a CEO, you have to recognize that this is fueled by massive macro tailwinds, things like production-linked incentives, surging defense orders, and a broad push for import substitution. When institutional money flows here, they are betting on national-level infrastructure shifts. It's like a giant puzzle, and your corporate strategy must align your company's narrative with these structural tailwinds if you want to capture that attention.
Moving right along to Section 2, Institutional Buying and Volume Signals.
Okay, so to really decode what the market is doing on a daily basis, we absolutely must understand delivery volume. While day traders might just look for volume sustenance above specific technical levels, like say a breakout above 5420 rupees, executives need to focus on delivery. High delivery volume proves when investors are truly taking ownership and holding the stock rather than just shuffling paper back and forth in intraday speculation. It is literally the ultimate metric of institutional conviction.
Now, this number right here is absolutely crucial, the 200-day moving average. The notes highlight that when bulk deals happen at prices hovering near this metric, it indicates a rock-solid institutional support zone. Institutions look at this level as a baseline of value. So, if your stock is approaching this level and you see a block deal with high delivery volume, boom. That is a massive signal that the smart money is stepping in to put a floor under your valuation. Here's a fun one. What if you see heavy volume in your stock, but your PR team hasn't put out a single press release? Pay close attention to this. Unusual volume without news almost always signals that institutions are quietly accumulating shares. They're doing this based on those broader sector tailwinds we just talked about, like the BFSI deal momentum or those defense orders. They are quietly positioning themselves for a re-rating of your stock before the rest of the market even catches on.
All right, Section 3, Managing Cap Table Transitions.
Let's put on our CFO hats for a second. Understanding the transition of ownership, specifically this private equity to mutual fund handover, is a real game changer. Look at the differing motivations here. The PE firm is selling, seeking a phased exit via block deals, usually at a slight discount to avoid crashing the price on the open market. On the flip side, the mutual fund isn't buying blindly. They see valuation comfort, specifically stepping in around 1.1 times book value, and they have a fundamental belief in a broader macroeconomic shift, like a revival in the housing credit cycle. As a CFO, understanding this handover is critical to knowing who your new partners are.
So during these transitions, what's the CFO's job? You have to validate the new buyer's thesis. You must carefully track and communicate specific corporate actions. The source data points out that updates on the order book, crystal clear management guidance on asset quality, and metrics like net interest margin are exactly what these incoming institutions are watching. You have to feed them the data that confirms their valuation comfort.
Actually, a quick side note here. It's super important to realize the context behind institutional outflows. The data notes that current mutual fund selling in certain sectors is likely just driven by client redemptions, not fundamental flaws in your business model. So if a mutual fund is offloading your stock, don't immediately panic. Understand the market mechanics. They might simply be facing liquidity pressures from their own investors.
And finally, Section 4, Navigating Event Risks.
Let's look at this through the COO's tactical lens. Operations and market perception frequently collide when unexpected news hits. When episodic volume spikes happen, it usually follows this exact 1, 2, 3, 4 sequence. First, a rumor surfaces regarding regulatory news. Second, you suddenly see high delivery volume from high-net-worth individuals buying the rumor. Third, everyone waits for the official exchange filing. And fourth, if that news isn't confirmed, you face the massive risk of a brutal price reversal.
To put that into perspective, let's look at the pharma sector. For a company like Gland Pharma, specific operational triggers like a US FDA approval or an update on a China facility are the precise keys that unlock massive valuation shifts. For a COO, this means your regulatory compliance and operational milestones aren't just internal targets anymore. They are the exact catalysts the market is trading on.
Which brings us to this incredible quote from the notes. Event-driven, not trend-based, till official confirmation. It absolutely hits the nail on the head. As an executive team, you cannot trust a sudden upward trend in your stock price, and you definitely shouldn't make long-term capital decisions based on it until you have that official regulatory confirmation in hand. The volatility is purely speculative until the ink is dry.
We've covered a lot of ground today, from macro sector rotations to navigating brutal event-driven volatility. So, as you analyze your own stock's behavior this coming week, ask yourself, is your leadership team truly reading these signals, adapting your corporate narrative, and validating institutional theses, or are you just watching the noise? Thanks for joining me on this explainer. Keep looking at the data differently, and I'll catch you next time.